Hi everyone, today we're going to be learning about the similarities and differences between tax deductions and tax credits. If you're new here, my name's Kathy and I teach math and financial literacy. If you have a copy of the guided notes for this lesson, you can fill them out as we go through the slides. If not, that's okay. You can find a link down in the description or you can just listen along. Okay, so what are deductions and credits? Before we can determine the amount of tax that a person's going to owe, we need to decide what deductions and credits they're going to qualify for. Deductions and credits will both lower the amount of tax you have to pay at the end of the year, but they work completely differently in how they actually reduce the amount of tax that you pay. So before we get into the differences between deductions and credits, I just want to emphasize this point right here, that the higher the deductions and the credits that a person can qualify for, the less tax they're going to pay when they file their income taxes at the end of the year. So again, more deductions and credits means less tax. Now we're going to look at the differences between the two and how they actually work to lower the amount of taxes a person will pay. So now we're going to get into how both of these things actually work to lower your taxes, and we're going to start with deductions. So here's how a deduction actually works. So before federal income taxes are calculated, there is an opportunity to subtract an amount of money from a taxpayer's total income. This is going to be called a deduction. Deductions will reduce a person's taxable income before any taxes are calculated so that then their taxes can be paid on a lower amount of income. There are two main types of deductions that you should know about. There's something called an itemized deduction, and there's a different one called a standard deduction. Generally, taxpayers are going to use whichever deduction is bigger so that they can have the most money subtracted from their income before their tax is calculated. That was a lot of information there. So let's look at an actual example of how that actually works. We're going to look at Joe and Sarah. Let's say Joe and Sarah both earned $50,000 this year. Okay. Joe is going to take a standard deduction. We'll get into the amounts of the deductions here in a minute, but for just a moment, just bear with me on how this deduction works. Joe is going to take a standard deduction of $15,750. Sarah is going to take an itemized deduction of $20,000. So Joe is going to be able to subtract the $15,750 from his income. Sarah is going to subtract $20,000 from her income. Okay. So we've subtracted those two amounts, and you can see here we have $34,250 for Joe, and Sarah took the $20,000 deduction and ended up with $30,000. So they have subtracted those amounts from their income, and the amount that is left is called their taxable income. This is the amount they're actually going to pay tax on. So who do you think is going to pay less income tax? They both earned $50,000. They took different deductions, and you can see their taxable incomes right here. Who do you think is going to end up paying less federal income tax? So it's going to be Sarah. So Sarah took a bigger deduction. So she has a smaller taxable income, which means her tax is going to be calculated based on a smaller amount of income. So that is the summary of how the deduction works. It comes off of your income, and then your tax will be calculated on the amount of income that's left. So one more reminder on taxable income. Taxable income is your amount of income after those deductions have been subtracted. This is the portion of the person's income that will be used to calculate the amount of tax that this person is going to owe. Okay, so back to Joe and Sarah real quick. I'm going to scroll back here. So we had Joe taking a standard deduction and Sarah taking an itemized deduction. Let's talk about what those actually are. We know that the higher the deduction, the less tax a person will pay. But how do you figure out how much of a deduction you can get? Let's start with itemized deductions. So an itemized deduction is calculated based on specific expenses a taxpayer incurs during the year. So that could be medical expenses, dental expenses, property tax, mortgage interest, gifts to charity, the losses from a federally declared disaster. All of these things will go on something called a Schedule A, which is a tax form. And the taxpayer will put in all the different numbers that they spent on these categories, and it will come out with an amount. And that would be the itemized deduction. So an itemized deduction is based on specific expenses that you had throughout the year. If you believe that you have significant expenses in any of these categories, again, you can complete that form called the Schedule A, and it will help you determine the amount you could take for an itemized deduction. However, the IRS put out a statistic a few years ago saying that most people, 87.5%, don't actually use the itemized deduction. They just take what's called a standard deduction. The standard deduction is much simpler. It's just a set amount that everyone qualifies for, and it changes every year, but anybody who's filing their taxes can qualify for the standard deduction. In 2025, it was $15,750 for a single taxpayer, and it was $31,500 for a married taxpayer filing jointly with their spouse. So standard deduction is just a set amount every year. Itemized is based on specific expenses that you might have had. Most people take the standard deduction because they don't have enough expenses to exceed this amount, and you would want to take the higher of the two. All right, so let's look at an example. Katrina is deciding between the itemized and standard deduction before completing her taxes. Katrina's income this year was $42,500, and she is a single taxpayer. She completes the Schedule A and finds out that she would qualify for an itemized deduction of $12,300. What is her taxable income if she takes the standard deduction? Okay, so we said that she had $42,500 in income, and we know from a couple slides ago, I said the standard deduction for a single person is $15,750. So we're going to subtract that from her income, and the amount she would pay tax on is $26,750. So this right here would be her taxable income with the standard deduction. Now her itemized deduction, she said right here that she completed the Schedule A with all of her expenses, and her itemized deduction would be $12,300. So let's try subtracting that. Income minus $12,300. And her taxable income with the itemized deduction would be $30,200. Which deduction should she choose? So let's think about this for a second. Would you rather pay taxes on $26,000, or would you rather pay taxes on $30,000? In this scenario, she would want to pay taxes on the lower amount. So a bigger deduction will give us a lower amount of taxable income that we have to pay taxes on. So she is going to choose the standard deduction. Because it gives a lower taxable income. So one more time, the higher the deduction, the lower the taxable income, which means less taxes have to be paid. Okay, now we're going to shift over to tax credits. So again, tax deductions subtract from your income before you pay taxes. Tax credits are a little bit different. Tax credits are actually used after the tax has been calculated. So tax credits will reduce the amount a person owes by subtracting an amount directly from the taxes that are owed. So again, we have our income, we subtract our deduction, and we find out how much tax we owe. Then once we know how much tax we owe, then we can apply any tax credits. So let's go back to Joe from example 1. Joe earned $50,000, and he took the standard deduction, and we subtract that away, and we know that his taxable income is going to be $34,250. And because his taxable income is $34,250, he's going to owe $3,875 in taxes. If you want to know how I got that number, you can watch the next lesson. The next lesson will explain a little bit more about where that came from. For now, just take my word for it so we can talk about the credit. Let's say Joe has one credit and he qualifies for something called a child tax credit. In 2025, the child tax credit is $2,200 per qualifying child. So tax credits are subtracted directly from the amount of tax a person owes. So he owed, what did it say? $3,875. But because he qualifies for this child tax credit, we can subtract $2,200 from that. And that leaves his tax bill at now $1,675. Let's talk about a few common tax credits. Because tax credits come directly off of the amount of tax a person owes, they generally have income limits that restrict high earning taxpayers from qualifying for them. So low to middle income families are the ones who often qualify for these, but every single tax credit I'm about to list has its own set of rules. We're not going to get into the detailed rules for these. I just want you to know generally the kind of tax credits that are out there. The earned income tax credit is designed to provide tax relief for low to moderate income taxpayers and families. And this tax credit is dependent on the income earned and the size of a family. We just talked about the child tax credit. It provides a amount credit on a person's tax bill for every qualifying child. In 2025, that was $2,200 per child. There are a couple of credits that people can qualify for going back to school, college, training programs, things like that. There's the American Opportunity Credit and the Lifetime Learning Credit, and they both provide a tax benefit for students who are at an eligible school. And I've got a few more here that are pretty common. Child Independent Care Credit, that's like a credit for daycare. Retirement savings credit, adoption credit, clean energy credit. And again, all of these credits have income restrictions on them. So if you make above a certain amount, you may not qualify for these, but they each have their own list of requirements. Okay. Before we finish this, let's do one quick summary of the similarities and differences between these two, because like I said at the beginning, they are often confused and talked about like they're the same thing. Again, they both work to decrease the amount of tax a person owes. However, deductions are subtracted before a person's taxes are calculated. So they reduce a person's taxable income so that they will pay less taxes. Credits are subtracted after the taxes are calculated. So a person has income, they subtract their deductions and calculate their tax. And then once they know how much tax they have, they can subtract credits that they qualify for to find their final tax bill. Okay, if you're following along on the guided notes, there are 5 practice problems on the back. I want you to go ahead and pause this video, and I'm going to go ahead and pull up my 5 practice problems. And once you've had a chance to answer all of those, we will go through the answers together. All right, so let's go through the answers to these practice questions. I hope you've had a minute to go through each of them and try them out. Let's look at number 1. Shania and her husband earned a combined $67,800 this year. If she and her husband plan to file jointly and take the standard deduction, what is their taxable income? Okay, so she's taking a deduction, so we know that we need to subtract this from her income. And we have $67,800 as their income. And the standard deduction says that she is married, filing jointly. We looked at this on the previous slide. For 2025, the standard deduction is $31,500. So that would leave us with a taxable income of $36,300. So this is the income that she and her husband would pay their taxes on. Number 2, Caitlin is a student who works a part-time job after school and a full-time job during the summer. This year, she earned $18,260. If she is a single taxpayer and plans to take the standard deduction, what is her taxable income? All right, so let's start with her income again. And we're going to subtract her standard deduction. In 2025, the standard deduction for a single person is $15,750. And that would leave her with a taxable income of $2,510. So that is the amount of income that she would pay taxes on. Number 3, Trina is a single taxpayer who earns $45,100 this year. She recently had several large medical expenses, so she completes Schedule A to determine whether to take the itemized deduction this year. She finds that her itemized deduction would be $19,500. All right, so her taxable income after her itemized deduction, $45,100 minus $19,500 gives me $25,600. What is her taxable income after the standard deduction? She is a single taxpayer, so we'll use the single standard deduction. And that would give me $29,350. Should she take the itemized deduction or the standard deduction, and why? So again, we want to look at her taxable incomes here and whether she would rather pay tax on $25,000 or $29,000. And it would be a good idea to pay tax on the smaller amount. So she should take the itemized. Because it is larger. Okay, number 4. Jake owes $4,589 in tax this year. He has one child who qualifies for a $2,200 child tax credit. He is also a student and qualifies for a $1,200 lifetime learning credit. How much tax does he owe after these two credits? Okay, so tax credit we can subtract directly off of the tax he owes. So he owes $4,589 this year, but he gets to subtract the child tax credit and the lifetime learning credit. And now he only owes $1,189. Okay, last one. Blake and Taylor are married and plan to file jointly. They have 3 children who all qualify for a $2,200 child tax credit. Last year, they earned a combined $95,400. What is their taxable income if they take the standard deduction? Okay, so deductions we subtract from income. So that would be $95,400. Standard deduction for married filing jointly is $31,500, which gives me a taxable income of $63,900. So then their tax is calculated, and it says they will owe $7,194 in taxes. How much will they owe after their 3 child tax credits? So we're going to take their tax owed, $7,194, and we are going to subtract 3 child tax credits. So I'm going to go over here on the side here. 3 child tax credits times 3, that's $6,600. So I'm going to subtract $6,600 from there. And that gives me a total tax bill of $594. Okay, this brings me to the end of the lesson. I hope this helped your understanding of the similarities and differences between tax credits and deductions. Again, if you'd like the materials for this lesson, you can find the link down in the description. Thanks for watching.